What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 22nd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to provide a long-term roadmap of expectations for where Bitcoin and the broader crypto space could head over the next coming weeks and next coming months going into the close of 2023, and try to give a good understanding about why we feel this way considering the macro environment and the data points that we have readily available to us. We need to think a bit conceptually here about what's been going on in the macro sphere and the banking sector, and what this likely tells us about what the Fed is going to do long term, as well as what it's not going to do. We've got a lot of things to dive into today's video. If you guys enjoy this video, consider dropping a like. It's one of the best ways you can support the channel, and let's go ahead and kick off the rambling. All right, so I want to go ahead and start by talking a little bit here about the total market cap for cryptocurrencies. I'd like to step back to this index or this key metric here within crypto markets from time to time, because I think it gives us a really good perspective about the broader trend of valuations in crypto. It's one thing to analyze Bitcoin. Sometimes Bitcoin will outperform, sometimes it'll underperform. And generally, since back in April of 2021, Bitcoin's dominance has been in a channel sideways, holding anywhere from around 40 to 50% market share, roughly speaking. So I want to come back to this chart later on, but noting that Bitcoin has this level of dominance, although we have to account a little bit for the discrepancy that these indicators account for stable coins. Roughly speaking, Bitcoin usually owns about 50% market share, and roughly altcoins hold the other 50%. Sometimes, at least right now, it's more around 35-40% for altcoins, the rest going to Bitcoin. And if we again take a look here, this is something we've seen time and time again. We saw this back between May to August of 2021 during the corrective event we saw during that period of time. We saw it here in October of 2021 here, as Bitcoin was going into setting its new all-time highs, and we also saw this in June of 2022. So this is a consistent, very important range here that we need to keep an eye on here. It could show us when Bitcoin is getting exhausted, when there's an exacerbated difference, and therefore altcoins may make up the difference, or what I think is most likely the case, that Bitcoin is likely overextended here, that we are experiencing a real discrepancy, a relief rally, and we're not seeing follow through the broader altcoin space, which again may signal that this is a short-term bump in the road. Now, I want to go ahead and emphasize again that we want to focus on this total chart. If we take a look here at the weekly, notice that we're getting into a very important band here. This is similar to the price action of Bitcoin, as you all likely feel it's probably a bit familiar if you take a look at the long-term timeframes like we do here on the channel, because Bitcoin is the driver. If Bitcoin long-term is not able to sustain a long-term uptrend, and we do not see altcoins following through, then altcoins will continue to stagnate and Bitcoin will likely not continue forward. This is a key telltale sign of relief rallies, and that we don't have the fuel, the fire, to be able to essentially start a long-term rally, which I think all of you out there, the vast majority of you, 80 to 90% of you listening to the channel here, are not trying to trade in the short term. You're wondering whether or not we're in the next bull market. And I'm here to try to tell you guys whether or not I think that's the case. And I got to tell you guys, this is going to be a very, very difficult range to get through. While right now we are looking like we may have the highest weekly close since back in January, mainly led by that rally in Bitcoin, this has been a range of serious significant resistance in the past, and also support during the last bull market, which means it's going to be a very important contestment range. Now, as you all know, we've talked about the idea that we're going to see, at a minimum, the typical bear market correction here. And again, if we're just going off of history here, most of those bear market corrections, at least the last one back in 2017, was around 88%. So we're roughly expecting that total market cap is going to come down, as this was kind of the blow off top of a decade of performance for cryptocurrencies, and really flush out a lot of that excess valuation. But it could take some time to play out, and maybe it's not going to go all the way down to that level. I'm not saying you guys need to wait for some abstract valuation or number. I'm just saying that we're likely a far distance away. And if you want to be more balanced, you should be buying into capitulation and expect that this is going to be a longer term bear market considering the macro environment, not to chase rallies after each and every time they have faded to lower price levels. Keep that in mind, okay? So what we think is going to play out here is we're going to be able to basically push up in the upper band of the channel and start to roll over here eventually later on into the year, possibly bouncing around that trend line and coming down into here around the close of the year. Now, don't take my drawing as gospel here. It's just something to be able to give you guys a visual representation of what may play out. I think essentially this is going to be the relief rally that breaks the camel's back. Once this starts to fade, once we break back down below that 200 week, once we've had enough time where we chop up in this range, it's going to trap enough traders. It's going to get enough people convinced that this is the beginning of the next bull market. And from there, that liquidity trap plays out and it starts to correct to the downside, leaving people liquidated on their positions after already squeezing shorts to the upside. And on top of that, liquidating longs, getting people to sell at a lower price level. This is again exactly what the Fed wants at play here and what other major central banks want. They want people to have their liquidity absorbed through financial markets, because if you can get that money, that excess money from the system that was printed through QE over the past few years, all the stimulus money, all the government support, if all of that gets absorbed into financial markets, that's going to help them meet to their inflation targets and get the money supply back in check so that we have supply and demand equilibrium, i.e., no inflation or no excess inflation like we've been having over the past few years. Now, again, I want to go ahead and talk about one of the key indicators that we utilize here, which is Lux Algo. And Lux Algo has been showing some really interesting stuff, which is that really, for a sense, as far back as 2021, Bitcoin dominance has been in this kind of general decline, entering into a supposed kind of consolidation channel here where we've had resistance and general support. And this has been a really great indicator to spot some great reversal points to either be exposed into Bitcoin or altcoins, to sometimes go into fiat or be exposed to crypto. But the general thing I want to emphasize is while Bitcoin's had this big wave of optimism over this past week, getting a lot of dominance, we are coming in to the resistance band here on Lux Algo. And while there's no guarantee that price can't go above there, this has been a really consecutive indicator on the weekly and monthly time frame for longer term trends. Again, I recommend if you guys are interested in using Lux Algo, use it on these time frames. For example, we can see here on the NASDAQ, and this will play into our broader macro thesis here, that over the longer term, the weekly time frame of the Lux Algo indicator will be able to help us spot when there are actual trend reversals or if the trend is mainly in check. If we are still continuing to see resistance at the points the indicator expects, it is likely a sign that we still have a ways to go down in the trend. In this case, in the bear market, we are expecting that relief rallies will be faded, that we will eventually see price move up into these ranges, face resistance, and start to drop down. Again, don't take the drawing as gospel, just here to kind of visualize it. And what's really interesting is that back during the last relief rally we had, back in August, when everyone thought the Fed was going to pivot, that the monetary tightening was over, we saw a harsh rejection right in that range here, exactly what the Lux Algo is pointing here. And you can see that this not only works really great during downtrends, which I think makes it a really suitable indicator for the environment we're in right now, but on top of that as well, we've got a clear sign here that this has been a beneficial indicator to spot buy the dip opportunities during bull markets. As we can see, this has been a generally powerful indicator to allow you to just know when to ride the wave. And sure, you can have the buy or sell indicators flipped on here, but I genuinely like to remove a lot of that noise. I like to see what the bands are telling me, because if I can find exacerbated points to short equities, to short cryptocurrencies, or if I can find excessive opportunities during uptrends to buy the dip, then I want to take those kind of trades. I want to take those kind of positions. I want to ride the wave of the year or multi-year trend that's playing out for me and take advantage of periods of time where we exacerbate from that broader trend, like we're seeing now. During these relief rallies, these are opportunities to short overvalued plays. Or again, you don't have to exactly short if that's not your game. It's totally fine. But at least take profits on any returns if you're trying to buy these relief rallies, right? And now if we clear through this, that could be a sign that, hey, maybe we are starting to see the beginning of a bull market. But again, I got to start seeing that on those weekly time frames. And we're entering into the price action concepts indicator here, as you can see between the bars, and each and every time here, this has been a period of time to sell. We can see the volume profile here for the sell side outweighs the buy side, meaning that this is likely a period of time for distribution, where there is enough market order flow from retail buyers to unload from larger institutions. So keep that in mind here. This is going to be a significant price range, which yes means likely the NASDAQ has some room to go up here. That could be led by players like Nvidia, FANG stocks continuing layoffs, but none of that is enough to sustain a long-term bull market. And that's what I want to get into talking about here. So just to let you guys know, if you guys are interested, feel free to check out LuxAlgo at the link down below in the description. I have a code there where you can get it for 30% off for your subscription, whether it be monthly, quarterly, or annually. Definitely give it a try if you're interested. I think it's a really great indicator sweep. We can see here as well for Ethereum that the same methodology here is showcasing that we're likely going to be coming down and retesting this range here, coming down in alignment here on the monthly time frame into around 0.045 for Ethereum. So that's going to be our kind of target opportunity where we think we could really get a good position on Ethereum and some other altcoin plays in the market, and perhaps that can line up here towards the kind of summer or close of the year where we get that final dip opportunity in crypto markets. It could happen sooner than we expect. Now, I want to go ahead and talk about this macro scenario here. Now, a lot of people are expecting right now, if we're really talking over the next 2 or 3 months, I think everyone seeing what's going on in the banking industry, seeing what the Fed has done already in response to this crisis, warrants a lot of people to believe that the Federal Reserve is going to come in big time with QE, that we are going to see the Fed come in and save the day, inject that easy money into the system, and stimulate asset prices in order to save the financial system. And to be honest, I understand why people are thinking that. The VIX spiked up, as we've been talking about here for months in February, that this spike was coming. Something was going to break eventually, as we've been seeing the VIX build up over time for the last 5 years. Again, as we just zoom out here, this has been a monstrous uptrend here with nice consistent lows. But on top of that, we had the United States Central Bank balance sheet revert back a couple months worth of reduction in liquidity, up towards around $8.6 trillion from around 8.3. So a couple $100 billion of liquidity injection. It's definitely no laughing matter. It's a good amount of liquidity, but is it enough to stimulate a new bull run? All right. Again, just zooming out here, we've seen much, much bigger moves in liquidity throughout previous recessions, like what we saw during the pandemic or what we saw back in 2008. Is this really the beginning of a new wave of QE? Or is this QE light? Or is it just simply a one-off event to protect liquidity in the financial system, to prevent bank runs? I think it's the latter, folks. I don't think this is enough to stimulate a long-term uptrend in asset prices. And once more, I don't think the Fed is going to continue very much off of this. If we check prediction markets, the Federal Reserve in the next meeting is expecting to still raise the federal funds rate by roughly about 25 basis points. And that's just off of the prediction markets, right? Fed could do nothing next month or for this FOMC meeting. They could do 50 basis points. They could do 25 basis points. We don't really know what's going to happen here. None of us really know. But the key thing I want to emphasize here is that even if the Federal Reserve pauses rate hikes, at the end of the day, it is beholden to inflation. It is beholden to the CPI, the PCE, the cost of goods and services. And the Fed knows damn well if they don't get on top of it now, if they don't break a couple things along the way, which is part and parcel here of a lot of the excess money that was printed over the last decade that allowed so many businesses that normally wouldn't exist to exist and burn through capital when it was cheap and easy. If they don't get rid of it now, it will stay in the system. Inflation will become more sticky than it already is. We had in our February reading on the CPI a month-over-month increase of practically 0.4%. Previous month, it was 0.5%. And while we did have some low months from October to December, we are still seeing that inflation is holding at a range where, roughly speaking, by the end of this year, we are still going to have an annualized inflation rate, if we continue at this pace, of around 4 to 5%. That is not the Fed's target of 2%. That is not stabilized inflation like we had over the last few decades. And until we can correct that, right? Maybe the Fed, again, could be wrong here. Fed deviates for a short while. It reverses its tightening on the balance sheet and takes it up here to 8.9 trillion. If the Fed does this, asset prices will move up for a little while. The relief rally or the kind of extended rally here in the short term will continue. But they will never be able at any point to inject liquidity like they did in previous bull markets or through previous recessions. Because the Fed knows if they do that, inflation's coming back up to 10, 12% easily. That's best case scenario. If the Fed really were to print like this, or print like this, or even expand the balance sheet like this over the next few years, you can kiss any progress goodbye if the Fed does that. So let's just go ahead and let's be realistic. The Fed's not going to do something that dramatic. It knows it can't do that. So what's it likely going to do here? Well, I think we're going to, again, continue that tightening process over time. We have to get back on track. If the Fed doesn't do that, then inflation will come raging back. Maybe not here in this FOMC meeting, but I think you're going to get the tone from Jay Powell that essentially the Fed cannot back out on this. They need to continue keeping rates suspended. And the unfortunate thing is that if they keep them suspended here and don't keep them on the higher band and keep showcasing that they're doing a little bit each and every month to get inflation back down to their target, inflation could very much come raging back. It could start to get up into these higher bands, right? Seeing 0.5%, 0.7% increases. That would not be good. We need the Fed to be in the driver's seat. We need the Fed to be leading here, right? And irrespective of what we think the Fed is going to do or what we would more specifically hope them to do, I think the best thing you guys need to be prepared for, one of the best charts you could see, is taking a look at the S&P 500 or the Dow Jones back in the 70s during the last wave of inflation. Now, I'm not the believer that history exactly repeats. Financial markets are very complex and they definitely don't repeat exactly, but they certainly rhyme. There are certain consistent patterns that happen during periods of economic downturns and more specifically during periods of inflation. The 60s and the early 70s were a prime example of this. During this period of time, inflation began its heightened journey where inflation was at heightened levels, and we can see that multiple times in the 60s and 70s, we had 3 major drawdowns, 2 recoveries. And in this cycle, what was interesting about it is it did take it up to the previous all-time highs. In fact, it set in new all-time highs, thereby then correcting down lower, right? So this is a good lesson for both the bulls and the bears, I would actually argue. It's a good reason why you don't want to always be so aggressive on shorting. And if you are going to short, right, short on those relief rallies and trade the broader downtrend, then make sure you got your stop set. Make sure you've got some risk management in place. Or if you're utilizing options contracts, things like that, that your time frames are long term and that you make sure that you understand the capital you're putting into it, you're willing to lose. You're willing for those options to expire, render worthless essentially, right? Again, you have to keep risk management here. We don't want to put all of our capital into some short, trying to bet against the market. And a big message, and the same narrative to the bulls. A lot of people like to think that equity markets are always up and to the right consecutively, like they were back in the early 1900s and like they were here during the 80s to the start of the millennium and here in 2009 to 2021. On the broader sense of things, that is the case. Asset prices do move up to the right. But there can also be periods of time, like back in the 30s to the 40s, like here between the 60s to the mid-70s, and also here from 2000 to 2013, where you can lose everything if you make the wrong moves. And this is the thing that all the other major crypto influencers, people on Twitter, a lot of traders just don't take the time to tell you. Because they're too busy promoting you to utilize their trading referral links, getting you to trade on leverage, taking risk at every turn. And it's the exact thing, alongside so many other mistakes you can make in financial markets, that'll leave you losing everything you've built up. Leaving you worse off than you would have been just dollar cost averaging, or being passive, or just really being in cash during these uncertain periods of time. I come back to this chart every couple of weeks, and I really just kind of look at it here. I look at the Dow Jones and the S&P 500, really consistent pattern here. The NASDAQ really is an indicator we can use from this time frame. But these indices tell us that during inflationary periods, we can have a lost decade in asset prices. This was over 10 years. 10 years of price action. And only then after that, after all the chop, did we have one of the best rallies we've seen in U.S. equities and in asset markets throughout history, during the age and the dawn of not only various forms of technology, but most importantly, the internet. So, look, guys, I'm just here to just be as honest as I can. There is going to be tons of trading opportunities here. And yeah, we'll definitely look at potentially going short on some plays. I know some people have been convinced that we're somehow short. We're not. We're in cash right now. We're keeping it simple, earning some good interest in our bank accounts, making sure that we've got our capital in defensive plays and positions, and sure, we have a little bit of exposure to crypto, but mainly we're in cash right now because that has been the best play to be in over the past couple of months. And sure, you can say, I should have bought this, I should have bought that. Folks, anyone out there who's telling you that, you missed the rally, or you missed this and that, those types of traders do not survive in bear markets. They will get chopped up. They will get tossed out. The market will chew them up and spit them out. I know it's a bit of a crude analogy, but you got to understand that institutions and larger players can play with your emotions big time. The exchanges, large players, they have all the data they need. And those who really know how to play the markets, who move price, market makers, they'll trick you up at one way or another if you were too eager to make a move and think about what you could make, but not what you can lose. Anyways, I've rambled on a good amount, guys. I don't want to speak as a monolithic opinion here. All I'm trying to do is just let you guys know about how choppy things can get. And again, as I mentioned, this is not just going for the bears. It's going for the bulls as well. 70s taught us anything. It can really throw off traders when we're in inflationary periods, when the Fed is giving us mixed signals and it doesn't address inflation properly. And while I don't think we're going to play exactly like this, there will be extended relief rallies that chop up a lot of bears as well. So anyways, guys, that's it for today's video. Thank you all so much for watching. If you guys enjoyed my rambling and enjoy me talking about financial markets, consider dropping a like. It's one of the best ways you guys can support the channel. And if you guys are interested in any of our partner tools like Lux Algo, you guys can check it down below in the description. But until the next one, everyone, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.